What we saw unfold over the weekend, the GST Council, led by Finance Minister Nirmala Sitharaman, met in Jaisalmer, Rajasthan for its 55th meeting. Among the key decisions taken, the Council approved an 18% GST on the margin value of used electric vehicle sales by businesses. Meanwhile, clarity was also provided on taxability of popcorn, with caramel popcorn continuing to attract 18% GST as it happens to be in the confectionery segment. Pre-packed and spiced popcorn taxed at 12% and unpacked and unlabeled popcorn at just 5%. However, many anticipated decisions of lowering tax rates on life and health insurance premiums, as well as an app-based food delivery services like Swiggy and Zomato, and GST implications on the delivery service itself were deferred. Moreover, in a relief for public welfare, the GST on fortified rice kernels distributed under public schemes was slashed from 18% to 5%. We have a guest joining us this morning, Avinash Gorakshakar, taking out time on this Monday morning, just 2 days ahead of Christmas. Avinash, good morning. Thank you for joining us on News 9 Live. First up, great expectations from the GST Council meeting. Nothing really concrete coming out of it as far as at least the premium on life and health insurance was concerned. There were also talks, Avinash, about maybe a go-in-between rate between 12% and 18%. Nothing really coming out from it. What was the market factoring in, and what does the market make of the announcements made on Saturday?
Yeah, good morning, Karthik. I think the GST meeting has not conclusively given any major announcements, and I think the market was obviously expecting some more, news flow on food app, companies, on the insurance sector, which I think could have been a little, positive for these sectors. But I think overall, the government is also probably in a wait and watch mode and doesn't want to take decisions in a hurry. So I think that was the possible reason why these decisions could not come about. And I think the markets would obviously, keep this, outcome from the GST meeting as a neutral stance. I don't expect any major downside or upside based on the announcements which have come out till now. So I think we'll have to wait and watch, Karthik, for maybe the next round of GST meeting. And maybe at that point of time, we could get some good news, for the food app as well as for the insurance sector, which I think are key areas the market was looking forward to.
The Finance Minister also in her press conference after the GST Council meeting said that there were speculations ripe about another tax rate being introduced. In fact, even we have discussed earlier that perhaps a 15% GST slab rate could be introduced at some point. Is there merit in the Finance Minister and the group of ministers really now considering another tax slab, or do you think, Avinash, that's going to complicate the GST slabs even more from what they already are?
No, I think, the current slab structure seems to be quite ideal. My sense is that, the government should ensure that it should make things more simple, and the structure has to be simplified, because if you introduce a new slab, that would further may create a little bit of confusion. So I think, it's still too early to talk about it, but I think, quite frankly, introduction of a new tax slab is not going to be the solution. Better compliance and better efficiency in collecting GST should be the key focus area. So I think, rather than having a new tax slab, I think it's better to focus on the existing slab structure and, encouraging the industry, because clearly GST has become a kind of a stumbling block for many sectors in terms of the demand, because as of now, consumption is down. Most manufacturers are looking forward that the government does not impose heavier GST on them, because that obviously impacts, demand, from the consumer point of view.
Okay, and the 18% GST on used electric vehicles when they are sold to a third party, not person to person, no GST. When electric vehicles are sold through a platform, a third party platform, and 18% tax. What does this do to the already dwindling demand of electric vehicles in India, Avinash?
No, I think, Karthik, this is definitely not a positive development, because, the government needs to encourage the use of electric vehicles, whether it is a primary sale or a secondary sale. And I think, this 18% on the difference is also going to be a significant amount of, outflow for the buyer of the electric vehicle. So I think it's going to obviously increase the cost of ownership. It's going to increase the cost of the vehicle. And as everyone is aware that even today the electric vehicle penetration in India is very very low. We need to encourage the electric vehicle segment at least for the next 5 years before we impose higher taxes like the diesel and petrol cars. So I think definitely in the near term this is going to be negative. Although the resale and the used market is not a very large market in India, incremental sales are now going to be a little more tougher because this is going to increase the cost of ownership for the customer.
All right, stay with us, Avinash. Let's move on from GST to another story that impacts your wallet, and this one comes by way of hotel tariffs. Room rates, which reached a record high in 2024, are set to continue on that momentum, if not climb even higher in 2025, with demand surging by 7 to 8% across segments. Now, despite foreign tourist arrivals into India still lagging behind pre-COVID levels, hotels across India are seeing near full bookings as the year draws to a close. Now, analysts attribute this trend to limited pressure from new supply, supporting high occupancy rates and continued growth in average daily rates. Meanwhile, the mid-scale and budget categories are also witnessing growth supported by improved infrastructure in both Tier 2 and Tier 3 cities and changing traveler preferences. Projections for 2025 suggested that hotel rates could rise by another 8 to 10%, with luxury properties seeing the steepest hike. Avinash, do you attribute this to just the Shadi season, the wedding season in the month of December, or is there more to read into a genuine supply problem when it comes to hotels in India?
I think, Karthik, there is a supply crunch, and I think hotel tariffs increasing significantly at this time of the year is not a surprise because October to December is the festive season. This is the time when most of the festivals and the celebrations are there: New Year, Christmas, Diwali. So I think clearly we are going to see very strong numbers from large players like Indian hotels, East India Hotels, even the smaller players like Chalet Hotels, smaller budget players like Lemon Tree, or for that reason, typically, companies which operate in a niche space like Royal Orchid, which don't own the hotels but manage hotels, we could see a lot of, improvement in the average room realizations, and that is obviously going to contribute to a very fat EBITDA margin. So I think this development is positive because supply crunch is going to continue for the next 6 to 12 months. Demand has been rising very sharply, but at the same time, supply has not been up to expectations. And therefore, in the Q3, one may see a disproportionate increase in the profitability as compared to the top line growth. So I think this is definitely good news for the larger, chains, specifically now, even as regards to ITC, because ITC's hotel business is also going to be demerged soon. And investors would obviously benefit here because this is also one of the second largest hotel chains after Indian Hotels.
All right, so let's stay with the hotel category, and you're mentioning IHCL and ITC on the price chart. Avinash, you've got ITC returning just about 3.15% year to date to shareholders. But the story on IHCL, the parent company of the Taj Group of Hotels, the share price has almost doubled in the same period. So what is it which is dragging the ITC stock down as compared to IHCL? And for a long-term investor invested in India's hospitality story, what is your advice to them?
No, I think, see, Indian Hotels is a stock where I think you need to take at least a 2 year view. And I think any dip in the market should be used as an opportunity to look at it from a long-term investment. As far as ITC is concerned, I think the market is fearing that in the coming budget, the government is going to tax cigarettes in a very significant manner. So the parent company is obviously looking, I mean, a little vulnerable because it's being the largest player in the cigarette market. And that is probably the reason why the stock has underperformed. As far as the demerger of the hotel business is concerned, although it may not be a very large business for them, in terms of the positioning, as I mentioned earlier, they are number two after Indian Hotels. The brand equity for ITC Hotels is also very, amongst one of the premium hotels. So I think one could look at, this ITC hotel stock once it gets listed, because there would be a lot of excitement around this counter. Apart from the retail, buying, I think institutional HNIs, a lot of quality investors are probably looking at entering into a focused play, which for a long time was, included in ITC. So I think, ITC is a long-term story. Again, from a long-term point of view, it could give decent returns to shareholders, provided one has a medium to long-term horizon.
Okay, medium to long-term horizon. I also want to bring Avinash EIH, the parent company of Oberoi Group of Hotels. Now, this stock has even outperformed IHCL. What is driving up the share prices of EIH? And again, for an investor already bought into the hospitality story, where does the investment journey go from here?
No, I think clearly EIH also is in a sweet spot because as we mentioned earlier, all the hotel companies which have got a prominent hotel chain in metros are going to benefit in terms of the pricing. In fact, pricing has been very attractive. Customers don't get rooms even at premium prices, and obviously during the New Year time or during festive time, hotel rates skyrocket quite significantly. So, in this industry where the fixed costs are similar, I think any incremental upside which comes from the room tariffs is directly contributing to the bottom line. So I think EIH also is very well positioned. In terms of outperformance, I think it would be as better as Indian hotels, provided, one remains in this kind of stock for a reasonably long period of time.
All right. So long-term investment is the name of the game when it comes to hospitality stocks. Well, we will also bring in the next segment the trading strategies for these very stocks if you are looking at intraday gains. But Avinash Gorakshikar, thank you so much for taking out time this Monday morning and joining us here on News 9 Live. We'll let you go for now.